Senate Republicans have released a sweeping set of revisions to the massive tax and spending bill originally drafted by the House. The Senate version retains the core of the House-passed legislation, narrowly approved last month, including a permanent extension of most provisions from the 2017 tax cuts, along with several key promises from President Trump's campaign platform. These include tax exemptions for tips, overtime pay, certain Social Security benefits, and auto loan interest under specific conditions. Some of the amendments introduced on Monday, June 16, may threaten the delicate compromise that enabled the bill's passage in the House. Internal divisions within the Republican Party, particularly between members from high-tax states and fiscal conservatives, could make final passage more difficult. Below are 14 key differences between the House and Senate versions of the legislation. State and local tax deduction, or SALT. While the House approved a $40,000 cap in an effort to appease lawmakers from high-tax blue states, the Senate retains the current $10,000 limit. Senate Republicans view the lower threshold as both a key revenue source and a guardrail against the federal government indirectly covering state-level tax increases. In the coming weeks, GOP leaders are expected to face internal pushback in the House as they seek consensus on this contentious provision. Clean energy credits. The House version calls for a faster phase-out or even early termination of clean energy tax credits originally enacted under the Biden administration's 2022 Inflation Reduction Act. The Senate takes a somewhat softer approach, allowing delayed start projects in wind, solar, nuclear, and geothermal to still qualify for certain incentives. For example, wind and solar developments that break ground in 2026 or 2027 would remain eligible for partial tax credits. According to a summary from the Senate Finance Committee, other technologies, including geothermal, nuclear, and hydropower, could qualify as long as construction begins no later than 2035. Even so, the changes mark a clear step back from what many investors and state governments had anticipated. Medicaid. The Senate takes a tougher stance on Medicaid-related taxes that many states have increasingly relied on, specifically so-called provider taxes, which states levy on hospitals and health care providers to draw down additional federal matching funds. The Senate would cap these provider taxes at 3.5% for states that expanded Medicaid under the Affordable Care Act or Obamacare, a sharp reduction from the current 6% ceiling. According to the nonpartisan health policy group KFF, more than 35 states currently use provider taxes and would be forced to scale them back under the Senate proposal. In contrast, the House merely freezes the tax at current levels without mandating reductions. The Senate would also cut certain supplemental payments that states currently provide to hospitals, whereas the House only limits future growth of such payments. Both provider taxes and state-directed payments are considered financial lifelines for many hospitals, and health care facilities are expected to push back strongly against the Senate's deeper cuts. Like the House version, the Senate includes work requirements for able-bodied adults enrolled in Medicaid. However, the Senate goes further by mandating that adults with dependent children aged 14 and older must also participate in community engagement or work at least 20 hours per week. The House exempts parents with dependents from these work requirements entirely. Business tax breaks. The Senate proposal would make permanent several business tax breaks that the House only extends on a temporary basis. These include full and immediate expensing for domestic research and equipment purchases, as well as retroactive deductions for research expenses claimed by certain small businesses. Economists say the Senate's approach could have a more positive long-term impact on investment and economic growth by giving businesses greater certainty and reducing the cost of capital. Pass-through deduction. For pass-through businesses where profits are taxed as part of the owner's personal income, the Senate preserves the current 20% deduction. The House version, by contrast, proposes increasing the deduction to 23%. University endowments. While the House proposes raising the top tax rate on university endowment income to as high as 21%, the Senate takes a narrower approach, capping the rate at 8%. Both proposals represent significant increases from the current rate of 1.4%. Charitable deductions. The Senate significantly expands the charitable deduction for non-itemizers while placing new limits on itemized deductions. Non-itemizers would be allowed to deduct up to $1,000 or $2,000 for joint filers, a notable increase from the current standard, which is either non-existent or extremely limited. Itemizers, on the other hand, would only be able to deduct charitable contributions that exceed 0.5% of their adjusted gross income or AGI. For example, someone with an AGI of $200,000 would not be able to deduct the first $1,000 of charitable giving. Only the amount above that threshold would count toward their tax deduction. This structure is intended to encourage broader giving among middle-income taxpayers, many of whom don't itemize, while curbing large deductions by higher earners. The move is expected to spark debate among charitable organizations and wealth management advocates. Revenge tax. The bill introduces a scaled-down version of the so-called revenge tax, a House proposal to impose a tax of up to 20% on companies based in countries that have enacted digital services taxes, targeting U.S. tech firms or that are participating in the global minimum corporate tax agreement negotiated under the Biden administration. Foreign-owned companies operating in the U.S. have warned that such a measure could deter investment due to its confrontational nature and potential for triggering trade disputes. Compared to the House version, the Senate plan makes two key adjustments. Caps the tax at 15% rather than 20%. Delays the effective date to 2027 for most affected companies, giving businesses more time to adjust. These revisions are intended to reduce the risk of international tax conflict and ease the transition for multinational firms. Seniors, tips, and overtime. The Senate adjusts several of President Trump's signature campaign proposals, opting for more limited versions than those passed by the House. The tax deduction for seniors would increase from $4,000 to $6,000 per person, a partial step toward Trump's pledge to eliminate income taxes on Social Security benefits. The proposal to make tips tax-free would be capped at $25,000 per person annually, compared to the House version, which had no cap. The tax exemption on overtime pay would be limited to $12,500 per individual or $25,000 for joint filers, whereas the House also left this exemption uncapped. Both proposals include income-based eligibility requirements, but the Senate's design appears more restrictive, especially for higher earners, than the House version. While the Senate keeps the symbolic elements of Trump's tax promises relating to seniors, tipped workers, and overtime earners, it reins them in through dollar limits and income thresholds in an effort to curb the potential fiscal impact. Child tax credit. The Senate proposes raising the child tax credit from $2,000 to $2,200 per child starting in 2025 and making the increase permanent. In contrast, the House would boost the credit to $2,500, but only for a temporary 4-year period. Both chambers include a controversial eligibility restriction. Households with U.S. citizen children would be denied the credit if the parents do not have a valid Social Security number for work, a policy change that primarily affects undocumented immigrant families. While the Senate offers a smaller increase, its version emphasizes long-term stability. Both versions reflect a broader shift toward tightening eligibility for immigrant households, a move welcomed by conservative lawmakers but likely to spark pushback from immigrant rights and child welfare advocates. Foundations. The Senate entirely drops a House-backed proposal to raise taxes on private foundations. The House would have increased the annual excise tax on a foundation's net investment income from 1.39% to as high as 10% in certain cases, aiming to discourage excessive asset accumulation in foundations that do not engage in direct charitable activity. By contrast, the Senate leaves current tax rules unchanged, signaling a more cautious approach toward regulating philanthropic capital. Health savings accounts. The Senate version does not include the House's proposal to significantly expand health savings accounts, or HSAs, which offer tax advantages for medical expenses. The House had pushed to raise contribution limits, broaden eligibility, and increase flexibility for withdrawals to cover a wider range of personal healthcare costs. In contrast, the Senate keeps current HSA rules unchanged, opting not to expand tax benefits or usage criteria at this time. Debt limit. As expected, the Senate raises the federal debt ceiling by $5 trillion, exceeding the $4 trillion increase proposed in the House version. Raising the debt limit is necessary to finance the new tax cuts and spending provisions included in the legislation. The higher $5 trillion figure reflects greater anticipated spending and a strategic move to avoid short-term default risks ahead of the upcoming election cycle. Remittance tax. The Senate retains the 3.5% tax on overseas money transfers included in the House version, but adds several key exemptions. Under the Senate plan, remittances would not be taxed if they are funded through certain types of U.S.-based financial accounts, or if the transfer is made using a U.S.-issued debit or credit card. These carve-outs aim to limit the impact on lawful financial activity while maintaining the tax as a potential revenue source. With over 1,000 pages of legislation and countless technical provisions, the Big and Beautiful Act presents a serious test for both Congress and the American public. Even as centrist media outlets attempt to provide balanced analysis, the bill is still widely interpreted through a politically polarized lens, either as support for or opposition to President Trump's agenda. The result is confusion and division, reinforcing the perception that Congress is gridlocked and the country is going nowhere. Depending on who you are, a tipped worker, a small business finance manager, a family with a loved one on Medicaid, or a resident of a border state, this legislation could represent a benefit, a burden, or both. Understanding this bill means understanding how America is redefining the role of government and the direction of the country in the years ahead, then deciding whether to support that vision.